confirm continuing disinflationary pressures. Also critical would be sustained high-quality fiscal consolidation. Given that there have been no substantial new developments on the disinflationary process or on the fiscal outlook since January 15th, it is appropriate for the Reserve Bank to await them and maintain the current interest rate stance. So that means that the next two data points would be fiscal deficit as well as the CPI data. That's the governor.
I have to say something before we start the question. So, given that we cut rates off cycle, and given there has been no significant new development on inflation and the fiscal front since then, we have maintained status quo on interest rates. However, we have taken actions in a number of other directions, and the details are in the document we have handed out. I'd be happy to address any of the questions there. Many of these are intended to further the growth process, and some are intended to enhance stability of the system. In terms of guidance going forward, the guidance remains what it was when we cut rates, that further action will be in the direction that was initiated, and that it will depend on developments, in particular on developments on the fiscal front, as well as a continuation of the disinflationary process. So our further actions will be driven by the data. Let me stop there and ask Gurjeet Patel if he has any anything to add.
No, not much. One thing that I would like to bring forth is that we are at the midst of an age of competitive depreciation and beggar thy neighbor monetary policies. As you know, the Swiss National Bank abandoned its PAG. Singapore eased its monetary policy on January 28th, and it fell to its lowest level since 2010. Central banks have intervened heavily in the bond markets, bringing yields down to historic lows. This reminds one of an African saying that when elephants fight, the grass suffers. And the economists said that the ECB and Bank of Japan are printing money and devaluing their currencies while the US economy is growing strongly. Anyone who stands in the middle risks getting crushed. I think this forms an important backdrop of our macroeconomic management as we go forward and face these quite unusual challenges. Thank you.
Okay, question time. Yes, Lata.
Morning, Doctor. You haven't given any guidance at all. Sorry, Lata from CNBC TV 18. You haven't given any guidance at all. If you can give us some idea of how you see the CPI trajectory with the old base itself. If it is only 6% as your forecast for Jan 16th now indicates, what will be the real rate that you will be comfortable with?
I've talked about all these, so I'm not sure what new guidance you want from me. I will reiterate that we are looking for developments on both the disinflationary process. We would like to see it continue. And of course, on the fiscal front, we have a budget coming up. So those are important developments that we will pay attention to. Now, I'm not going to give you a number that I'm looking for in each of these things. These are more complicated than particular numbers. They're a whole package. We would like the forces that are in play, including the transmission of lower oil prices. Of course, oil prices went up in recent days, but our hope is that the modal estimate is these things will stay low for the coming year. That as these lower prices feed into prices more generally, that will help the disinflationary process. Also, we've had a relatively stable exchange rate so far. That will help also to some extent. And there has been, some actions on food management. Of course, this is the season when vegetable prices start picking up, and we want to see how those will play out. But there is no single item that we're waiting for, but we need more data than we had on 15th of January, and we haven't had significant data since then. So until we get more data, I think we're on pause.
So, I understand until you get data, but if you could reiterate what kind of a difference you want to see between inflation and policy rates. Do you want to see a 2% difference? Do you want to see a 1.5%?
Oh, you're looking for what we think is a reasonable level of the real rate. I've said before that we think that between 1.5% to 2% is a reasonable real rate given where we are in the business cycle. Now, of course, different people have different views. You had a panel discussion with Dr. Rangarajan where he would like to see it closer to 3. There are some people who would like to see it closer to 1. There are others who mix and match and add in various risk premia and claim that the policy rate is now way into real territory. So we have to be a little careful. What we would like is the real risk-free policy rate to be about 1.5% to 2%.
You'll veer towards 1.5 or 2 because you've always been giving that.
We'll go to the next question.
That gives me sufficient degrees of freedom.
Okay, next question from Saloni.
Good morning, Governor. Very happy birthday, first of all. Sir, to begin with, I would like to know your sense on the new GDP series. Now, what one camp is saying is that this reduces the room for monetary easing, while the other camp, and I was reading some articles this morning, says that this gives RBI the excuse to tighten monetary easing. What's your sense on the GDP series, considering the fact that the FY14 target has jumped substantially upwards?
We do need to spend more time understanding the GDP numbers, and we will be watching February 9th releases with great care and delving deeply into what we see there. At this point, it's premature to take a strong view based on these GDP numbers. Most of the data that we have seen for 2013-14, except inflation, which was very strong, give us a sense that there was slack in the economy. I think the chief economic advisor has pointed to the fact that imports, non-oil imports were coming down substantially, but there are other factors, including, for example, auto production, which is a fairly clean number, which were coming down over this period. So we find it hard to see the economy as rollicking in 2013-14. However, we must understand better why those numbers kick out, and it could be that it's not manufacturing, but services, which was stronger during that time. One of the interesting factoids that you see is that India is moving more towards consumption of services away from consumption of manufacturing. So it could play a bigger part in consumption. But I don't want to say anything about the numbers till we understand them better. Let me say that our view will be formed only in part by numbers. It will be also other indicators that we look at on the strength of the economy.
Governor, the second question is on something that you mentioned in this policy as well, and you have mentioned time and again, on rate transmission. You've given two separate examples. One, the recent rate cut that we saw on 15 January, and prior to that as well, there has been hardly any rate transmission. Post 15 January, only two banks went ahead and cut their or revised their base rates. Is there a nudge required from the Reserve Bank of India when it comes on, with regard to the rate transmission?
See, the Reserve Bank is not the owner, is not in any way involved in the day-to-day running of the banks. That's a decision that the owners and management have to take. So we cannot nudge them. We can only comment on the fact that despite a fall in long-term interest rates, a substantial fall, treasury rates have come down a significant amount over the last year and a half. and corporate bond rates have also come down substantially, that bank lending rates have remained more or less flat over this period. Now, you see some movement on new loans made by banks. There's been some adjustment in rates, but in general, base rates haven't changed. Of course, when you talk to banks, they're very happy that we cut rates. At some point, my guess is transmission has to take place. So we have to look at that also.
Vijay?
Governor, a couple of questions. The first one,
please, one question.
Yeah, okay. The first one, the simple question is, you just mentioned that until there are further triggers, you're effectively in a pause again. Having seen the experiences of going for the baby steps approach in the past as an institution, would you at this point be looking at more significant measures and then pauses rather than going for a long-winded baby steps approach?
Look, we've paused for 15 days. Come on. Monetary policy is a long-term process. So don't hold me every 15 days to something new. What we have said is we're waiting for data. We have a budget coming up. That's a significant change in the fiscal space. It is going to be an important change. We've got new GDP numbers coming on February 9th, which will reflect a whole new view of what's happening in the economy. We've got inflation numbers coming. This is all data that we need to watch for. Now, if I cut interest rates today, again, 2 weeks from now, you'll be asking me, when are you cutting rates again? So let the monetary policy process follow its due course. And monetary policy, remember, works with long and variable lags. In India, approximately 3 quarters. So we cut interest rates, it makes news for you, but it doesn't do anything for the economy for 3 quarters. So what we need to do is take into account the whole view, knowing that we are steering a ship which moves fairly slowly. So we need to work with that, and we need to take all the information we need. I said again and again, I'm not for doing one thing and then reversing that. So we will do it as and when the information comes. There are important pieces of information we're waiting for. As soon as that comes, we'll be in a better position to decide.
So can I, the CPI is also being rebased. So we don't know where that is moving. And it wouldn't be terribly responsible for us to take that as not an important component into what this thing is going to look like if you see what has happened to the GDP numbers. In terms of the forward guidance, I think that what was said in December and then in January, which the governor has reiterated several times, is that once we have embarked on a change in the direction, we will stay put in that direction. I think that's adequate forward guidance. And the fact of the matter is, since January 15th, we have had no substantial data point on practically any macroeconomic variable.
Governor, just to clarify on, you spoke about stable interest FX rate. How much of that is consideration in when you all are intervening also, because it has also been an issue that there has been a lot of talk about RBI intervening. Is there a sense that there is excess appreciation also?
I think it's too early to say that the exchange rate has played a big part in the export numbers. In fact, if you look at export volumes, they're still up for the non-oil, non-gold, non-jewelry part. And I think at present it would be wrong to say that we have become grossly uncompetitive. And as you know, there are different estimates of what the appropriate exchange rate is. If we just add inflation, we get the sense that our real effective exchange rate has appreciated quite a bit. If we couple that with productivity growth over time, then the appreciation is significantly more moderated. But that said, as Deputy Governor Dr. Urjit Patel started off saying, we have to be a little careful in this world. As I've said in past meetings, people keep looking at the exchange rate vis-a-vis the dollar and say our currency is weak, but we have strengthened versus virtually every other currency. So it is something that we have to be watchful for. We do not intervene to try and target a particular level for the exchange rate. Where we do intervene is to reduce volatility, and we have intervened in both directions in recent months and weeks. So we both buy and we sell. So it is not in any way an attempt to go one directional. I mean, I think we're perfectly comfortable with where the rupee is, but it is a risk that we have to keep in mind going forward with the massive amounts of quantitative easing that are going on in the rest of the world, that there are possible dangers of us becoming uncompetitive on that dimension.
Neha?
Yeah, Governor, happy birthday. Neha from Reuters here. Actually two tiny questions which I hope qualify as one. Okay, one is you vomited the inter-meeting move which you mentioned last time. So is that saying that you won't do that again? And second, you've allowed foreign investors to reinvest coupons in government bonds. I mean, just wanted to get a sense, why not just open up the limits for longer term investors? Wouldn't that just been safer instead of for the short term?
The two questions. No, we said it once. Now, we don't need to reiterate the possibility that inter-meeting moves are always on the table. They're never taken off. They've always been on the table. So I don't want to keep emphasizing. The last time we emphasized because we had done actions during meetings, and we'll try as far as possible to stick to meetings. But one reason we did it last time was because we had said in public that we wouldn't wait, I think the phrase was a minute longer or an hour longer, a moment longer than when the data suggested we could start cutting rates. And given that public statement, we felt that as soon as the data suggested, and there was no more data awaited, we would cut rates. So remember, all the inflation data had come in, including WPI inflation, and we cut rates on the 15th. Now, there's been no data since then, right? So we will await more data, including the important data on CPI rebasing that Urjit talked about, as well as fiscal developments. And after that, we make judgments about what next happens. But there's no conscious desire to omit that part of the language. The second question was on reinvestment of interest. Now, we do want to manage the country's balance sheet to make sure, as I've said before, that we have a bulletproof balance sheet when the inevitable interest rate rises come. Now, we have taken two actions in that regard this time. One is we recognizing that we would not like to be seen as against foreign investors, and given that we want to expand limits on a regular basis, given the interest in India today, if we just expand the FPI limit in government securities by some, let's say, $5 or $10 billion, it will be taken up in a couple of weeks, and we'll still get people wanting us to open more. We thought a more streamlined way of doing it would be to allow reinvestment of interest, which is a more regular feature and which will allow some room for our patient investors who have stayed with us and have taken the coupon to reinvest their coupons. So that was the reason for the government securities. We have seen a considerable amount of investment at the short end in corporate securities. And in the same way as we did not, when we limited reinvestment in government securities below 3 years, we did not do the same thing for corporates because we wanted to develop the corporate market also. There has been some of that, but again, there's too much sitting at the short end. And we would like to nudge people into the longer end. So we've said when you reinvest in 3 years and above securities. Hopefully, that will alleviate some of the pressure that could be building up in the corporate debt market. And this is a prudential measure again. Let me emphasize, we are open to foreign investors. We welcome them, which is one reason the FDI action we have taken today. That is, these put-call options that were embedded in various investments, we've said we're not against them. We just want to make sure it's not hidden debt. So if you have a put option, but the put option is at a price which is lower than what you invested, so you don't get a guaranteed debt return, we're okay with that. So we're trying to make it easier for foreign direct investment. There are other features that were earlier not favored, which we will open up as we look into this and come out with a detailed paper. But the idea is to make it easier for foreign direct investment, even with a variety of contractual features that would allow these investors to put money in.